Well, earnings season well underway, and it's shaping up to be a strong quarter, especially for the S&P 500. Almost 50% of its listed companies reported results so far, and nearly 4 out of every 5 have beat Wall Street estimates, according to FactSet. So, in the peak of the earnings season, where should investors be putting their money in the market? For more on this, we're joined by JoAnne Feeney, Advisors Capital Management Partner and Portfolio Manager. JoAnne, great to see you and grab some insights from you as always. There's a lot of chatter around what this higher for longer rate environment means for the prospect of some of the most crowded trades, namely in tech and the Magnificent Seven. I'm wondering how you're evaluating and running the calculus around this right now.
Yeah, Brad, morning. Clearly those companies have grabbed a lot of attention and they've done well despite the fact that rates have remained higher for longer. A lot of folks were betting that rate cuts this year would propel those growthier tech stocks, and that hasn't been necessary. And the reason why it hasn't been necessary for those stocks to appreciate in this environment of higher for longer is because of their earnings and their sales. And the results we saw last week only give investors more confidence that many of those companies, though not all, are on track to continue to grow 20-30% per year for the next few years. And we have generative AI to thank for that, as that really does transform a lot of the ways that companies and consumers will live over the next many years to come.
With all of this in mind, and we were talking about the percentage of the earnings season that we've got past, roughly 50% of the S&P 500 companies have already reported, and last week was one of the busiest weeks of the first quarter earnings season. All of this considered, what is the theme that is really more pronounced and is continuing to be a common denominator from your perspective?
Brad, there's a lot of mixed information coming out of the markets. I mean, some areas of the economy, you'll listen to some companies during their earnings call saying, hey, there's weakness out there. Demand is weak. We are just getting through, or, hey, we are still clearing inventory. So, there is a lot of disparity, and that really does make it important to select individual stocks and not just invest in the whole market. Because the market, by some metrics, is kind of on the expensive side. So you really want to drill down and make sure that if you're focused on growth, if you're a long-term investor, and you have a decently long time horizon, there are plays you can still get here. Like a Microsoft or an AMD or a Broadcom, but you can mix that in to take into account the fact that there's some rockiness in this economy. And we're a little bit worried about the resilience of the consumer this year after such strong growth for the last several years. And so there are ways to play that too.
And so that is something that the Fed is going to be laser focused on. We came into this year, 5, maybe even 7 rate cuts were on the table from some economists out there. And sure, lofty and as high as that was, we've started to see that be pared back, trimmed back. And for some economists, they're saying, you know what, it might just be December. Or if we see 2, it might be September and then December. For us running our calculations and investors out there that are trying to best get a sense of how many rate cuts we might actually see and what that means for the markets and potentially seeing new all-time highs, even in the face of less cuts than anticipated, do you think that we might actually see that come to fruition where a market can continue to rise despite the Fed not giving the market the anticipated amount of rate cuts, at least at the start of the year?
Yes, our view has been for the last year or so that the Fed was going to stay very focused on getting inflation under control, and that there were dynamics in place, a shortage of labor, for example, that would continue to keep upward pressure on, say, wages, which would feed through into inflation. So the Fed was going to have a hard time cutting rates. We didn't expect what the market did. And on the other hand, though, it does mean that the economy has been pretty strong. More and more people have been getting jobs, and that has supported consumer spending growth. So it's sort of a good news story. Yeah, the Fed hasn't been cutting rates, but that's because the economy has been strong. That used to be a pretty significant headwind for growth-oriented stocks, but what investors have found is that companies can still grow their sales and their profits in a way that raises the value of the company. And so what you have to do is not look at the market as a whole, but look at individual companies with strong demand drivers, that they're in the right place in the market for how the world is changing, whether it's rolling out new software, whether it's NVIDIA and providing the key chips that make AI work, or a ServiceNow that is providing the capability for businesses to deploy AI. So it's really important at this time to look for individual opportunities and not look at the market as a whole.
JoAnne Feeney, Advisors Capital Management Partner and Portfolio Manager. JoAnne, always a pleasure to speak with you. Thanks so much.
You bet, Brad.